once again facing buying back borrowed Bank of International Settlement gold leases into a 17-month series of physically determined higher prices. And there's just not enough speculators left to lay paper gold liabilities onto to offset how much unallocated gold and silver is being alchemized by China and Russia right now, right under our noses. Well, that really just leaves one question. We global gold and silver buyers are no longer in the minority. We used to be. We're not in the minority anymore. So my question is, have you also joined the global majority movement as quickly as possible, converting their rapidly depreciating debt-pat fiat currencies for physical gold and silver?
Silver's real breakout hasn't happened yet, and according to Andrew Maguire, that's by design. He points to BRICS nations, especially China, as the quiet force holding prices back from a rapid jump to $50 or even $100 an ounce. It's not about lack of demand, it's about strategy. Maguire says these buyers could push prices up overnight, but they're keeping the climb controlled. And there's a reason: to keep the market stable while they build their positions. He's watching two primary triggers that could flip the switch: rising geopolitical tensions and tightening supply. One major factor: Russia's decision to divert roughly 1,400 tons of annual production straight into military stockpiles. That move alone could tip silver's supply-demand balance sharply upward. Then there's what's happening on COMEX. In August, the contract rolled into December with a $59 premium, something Maguire hasn't seen across multiple cycles in years. If those delivery premiums keep growing while vault inventories keep shrinking, he says it'll be a sign that the paper price control that's capped silver since 2011 is breaking down. And here's the twist: he doesn't think Western institutions will lead the next big move. Even though HSBC has upped its 2025 forecast to $35.14, Maguire believes the real push will come from Eastern buyers, central bank diversification, and military demand. Fundamentals will still matter, but this time, they'll lag behind the geopolitical drivers. Andrew Maguire's analysis paints a picture of global precious metals markets standing at the edge of a structural transformation, not because of some distant theoretical shift, but because the very mechanisms used to suppress prices for decades have now created an irreparable fragility in Western paper markets. China, faced with a choice between accepting Western price manipulation or establishing physical market dominance, will always choose sovereignty. They will build vaults, they will accumulate metal, and they will systematically undermine the very system most investors still mistakenly trust: COMEX and LBMA price discovery. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Yeah, with the physical silver trade now largely bypassing Loco London, we looked at this last time, these same actors in silver futures are still exposed, well, not just silver futures, but also to unallocated spot silver, are still exposed to these Office of the Comptroller, OCC derivative bets, which are being targeted for delivery by the physical markets and have become increasingly difficult for the Fed to cover. And this is evident by way of declining open interest, or let's say the number of chips in play. Now, with the COMEX silver market paper settled liquidity, alongside producer financing initiatives, all leaching out into the Chinese physical exchanges where they're properly benchmarked, silver has now largely escaped the LBMA stranglehold. Now, these same actors are having difficulty in containing silver. Now, the reason it hasn't spiked any higher is that the savvy buyers, the controllers, are in China, and they're sitting back and letting the specs and the paper market guys do their thing. They've got control. They can let this run to 50 tomorrow. They can let it run to 100 tomorrow. But it doesn't suit them right now, but it's coming. Now, also, let's not forget, Russia is the 8th largest global silver producer and is estimated to produce about 1,400 tons of silver in 2025. Now, with the Russian central bank and the military complex recently diverting local production to stockpile silver, liquidity providers assess that this additional global offtake is not factored into the current supply-demand silver price, which is already in a deficit. And it is so disruptive, it tips the global supply deficit to force other competitive buying from China, India, and also from consumers who are going directly to the mines to produce, to source supply. Now, while spot silver is not Basel III compliant, it's important to understand this. Yes, it's not Basel III compliant, but it is a deliverable foreign exchange cross against the dollar, pound, euro, etc. And as with silver, and because silver supply is getting priced outside the LBMA's control, the Loco London Global Silver FX Fix benchmarking the global physical supply demand settlement price will have to rise to meet this fresh demand. And that's further going to drain Loco London's supply, which is already at critical levels. Now, the silver fix actually benchmarks a direct producer to end user price. And so any discrepancies are simply being arbitraged. And liquidity providers report continued accumulation of underpriced LBMA CME silver is currently now in the BRICS crosshairs, as it have been for some time, but it's stepping up. And very, very, very short term, silver under $38 is unsustainable. As we recently indicated, silver well into the 3 digits. Now, while this tokenization gateway opens up every single commodity to be traded and settled intra-BRICS national currencies, we've been focusing on the West's gross underestimation of BRICS nations' ability to take full control of the gold and silver price setting mechanisms, just understanding that when a leveraged, unbacked futures contract for gold or silver moves into expiry, as the August contract just did into the end of July for delivery on the 1st of August, it loses all its premium, which is called contango. And then it trades at the same price as the deliverable spot Basel III compliant global facing foreign exchange market, where it's possible to actually take delivery of a physical bar. Now, everything's going to make sense because as the August contract expires, it reached the same price as the deliverable contract. It makes sense because that contract just expired. So traders who don't want to be forced into taking delivery of their August COMEX longs or the shorts being demanded for delivery, they either exit or close and then roll further positions into the next liquid contract. In this case, it was the December contract, which at a rollover price that traded $59 higher premium to the deliverable spot contract. So that'll all make sense when we look at the charts. Now, the futures premium price over the spot price, what it does is allow for the carry costs. There's insurance costs, there's storage costs, etc., until the December contract goes into delivery on the first day of December. So obviously there's a period between August and December. But as a side note, given that gold is only fractionally held, the cost to carry is actually arbitrary. However, with the general mechanics understood, let's dig into the charts to uncover these footprints. And guess who's setting the COMEX price right now? So as we've just highlighted, really, the Fed is once again facing buying back borrowed Bank of International Settlement gold leases into a 17-month series of physically determined higher prices. And the last tool in the toolbox, we're just pointing out, is blunted, and there's just not enough speculators left to lay paper gold liabilities onto to offset how much unallocated gold and silver is being alchemized by China and Russia right now, right under our noses. Well, that really just leaves one question. We global gold and silver buyers are no longer in the minority. We used to be, we're not in the minority anymore. So my question is, have you also joined the global majority movement as quickly as possible, converting their rapidly depreciating debt-pat fiat currencies for physical gold and silver?
Gold has surged to a fresh record high after the U.S. confirmed import tariffs on 1 kilo gold bars, shaking global bullion markets. Futures peaked at $3,534.20 before settling near $3,488.90, up 1% on the day and tracking for a 2.4% weekly gain. Amid these moves, Andrew Maguire, a London-based precious metals trader and whistleblower, warns of a more profound structural shift. He argues that supply-demand fundamentals point to gold's fair value at around $8,000 an ounce, a conservative estimate. Maguire highlights how a $100 futures premium, leveraged at 96-1, has long capped gold below $3,500, but believes these manipulative tactics are weakening, potentially paving the way for a significant price breakout. Meanwhile, China is accelerating its efforts to wrest pricing power from Western exchanges. The Shanghai Gold Exchange has opened its first offshore gold vault in Hong Kong, allowing trading in yuan rather than US dollars, a direct challenge to the dollar's dominance in the bullion market. As the world's largest gold producer and consumer, China is moving to strengthen its influence over global pricing. At the recent BRICS summit, Maguire underscored how China's rapidly expanding vaulting network, stretching from Singapore and Hong Kong to Saudi Arabia, Russia, Brazil, Africa, and Southeast Asia, is already providing enough physical market liquidity to benchmark a globally determined, physically delivered gold price. Let's get back to the interview.
Now, we've been drawing a lot of attention to how the only tools left in the LBMA CME gold price suppression toolbox are failing and are ultimately leading to an imminent US Treasury gold price revaluation. Now, the scope of tool number one, which is the gaming of the COMEX exchange for physical premium. In other words, there's a COMEX price and it has a premium versus the Basel III compliant backdoor, which is usually as a lower price. So one starts off high and then they kind of marry together as the contracts expire. So I want to go through them because it really confuses a lot of people. And it really should be simple. And I think by using a chart, we'll look at how simple actually it is. Because what's happening is that this tool number one is essentially the COMEX market. Now note how this $100-odd premium, leveraged at around 96-1, had enabled gold to be pinned for 4 months in a row, capping gold from rising above, let's just raise it up here, capping gold rising above $3,500 to $4,000 an ounce. Well, $3,400 to $3,500 actually. But as we will demonstrate, and here just as a perfect example again, this is where a prior contract opened and then suddenly down it goes. And then again, with same process. And the reason I'm doing this again is to understand why it's not going to work anymore. But nevertheless, that $100 premium leveraged at 96-1, really, it has maintained a cap, but it is backfiring. And guess who against? The only actor still trying to cap a rising gold price, which is the Fed. Now, if you remember, putting this into context, 2 months ahead of gold being reclassified as a physically deliverable Basel III NSFR first tier high quality liquid asset on the 1st of January. And this they covered just before that. It's basically 2 months ahead of that, in the know that gold was going to rise. So they covered all their remaining 500 tons of gold derivative bets. And they did that alongside every single global central bank, sovereign and bullion bank, ditching all their gold derivative risk and going long for their own books, all in tandem, anticipating higher prices. Goodness, even the outlier Citi has now reversed its bearish gold stance, now calling for 3,500 in November. If you remember, it was Citi that was calling for hundreds of dollars lower and failed to get it. Now, if you remember, we drew attention to these bets, and these are foreign exchange bets, unallocated foreign exchange bets that trade outside of the futures market. These bets were made by the Fed. Now, their agent bank, JP Morgan and Citibank, were the primary. Goldman has long escaped capping gold. So the two primary banks that we drew attention to, and if you look at the precious metals 5 years maturity bets, so JP Morgan and basically Citibank were the only two making derivative bets out for 5 years. So now, look at where we are now. They've covered. So it says everything. And as we've assessed in the past, these bets are undoubtedly linked to the 8,133 tons of rehypothecated US Treasury gold. And so that's proof of capitulation, because since the last report, JP Morgan and Citi have exited their longer-term bets. This gap close also captured in the daily charts, which we've seen in the past, time after time. But essentially, the only bad actor willing to risk exposing themselves to fight the losing proposition of a rising gold price against the dollar is the Fed. And as we just witnessed, the lack of futures market Basel III compliance has once more enabled them to employ futures market leverage to synthetically dilute the price into an end-of-month mark-to-market event. And if we drill down into, say, the very short-term charts, it's pretty clear. This was 100% an official driven overshoot of very strong physical demand. And it was jumped on by the physical exchanges. The reason they did it here was exactly, this is the point where they have to value these huge bets that were made, billions of dollars unallocated foreign exchange gold and silver direct bets. So following on from our last episode, where we delved into the gold-backed tokenization and financialization of really potentially trillions of real-world assets, and based purely on supply-demand gap filling, this leads to a fair value price of 8,000 gold, and that is conservative. So if you remember, we used to see $50, and in fact as high as $100, but we used to regularly evidence $50 higher prices, yuan gold prices, than London, and how this regularly drove a massive arbitrage opportunity as underpriced Western exchange traded fund and COMEX gold and spot gold, unallocated spot gold, was drained to capitalize on these real world premiums. Therefore, due to its global fungibility, and this is the key, because gold is fungible globally, when the price of gold in yuan is higher than the LBMA fix, nations seeking to pay for or deliver commodities in exchange for their national currencies, they'll simply buy London spot and arbitrage the difference. This has created a backwash into the LBMA fixes, forcing really unwanted discipline upon it, because the unallocated gold in London, other than at the fixes, has up to a 20% haircut. Now, as we drew attention to during the BRICS summit, backed by central bank sovereign and fresh safe haven physical demand, China's expanding Shanghai vaulting network that's been established, it's being established in Singapore, in Hong Kong, Saudi, Russia, Brazil, Africa, Southeast Asia. It's global already, and they're already, this group, these vaults have already aggregated sufficient physical market liquidity to benchmark a global, physically determined supply-demand gold price to be locally delivered. Now, tokenizing BRICS collaborations into stablecoins and backed by real assets, along with a race to secure as much gold as possible to back the value of each nation's foreign exchange currencies, provides the BRICS nations and their counterparties with a very liquid 7-second settlement process, maximum 7 second settlement process. And bearing in mind that you've got vaults around the world where literally a T+0, because it's fungible, a T+0 delivery can be moving gold from one side of a vault to the other nation's holdings place. So while everyday BRICS pay transactions that people look at are not directly backed by a weight of gold, they're ultimately underpinned by a yuan gold standard. So sales of goods and services and commodities are valued against gold. So that's how they're benchmarked, and then directly convertible into physical gold. This is what is going on. It's just not realized. Ultimately, with gold increasingly backing real-world assets, the US administration...
Pressure is building beneath the surface of the precious metals trade, where control of pricing is quietly slipping from long-established Western hubs toward a network of physical markets in the East. The infrastructure is in place, the reserves are growing, and the mechanisms that once kept values contained appear to be weakening. Once the balance tips, the pace of repricing could be swift enough to catch much of the market off guard. If that tipping point arrives, will the next benchmark for gold and silver be set by futures desks in New York and London, or by vaults and trading floors thousands of miles away? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.